Hello and welcome everyone to the week ahead commodity report, where we of course will be reviewing the markets for the week ahead. And really following on from last week's report, we have seen that slingshot move higher for the metals that we discussed with you. Precious metals surge as Joe Biden was sworn in as the president of the United States on Wednesday. Traders are now convinced that the Biden era will usher in that next phase of commodities bull run, following on from the comments from US Treasury Secretary nominee Janet Yellen on Tuesday, which further propelled the metals higher at the start of last week. Janet Yellen on Tuesday urged lawmakers to act big on the next coronavirus stimulus package. So as we enter the Biden era, traders are expecting starting with a bang by passing the massive $1.92 trillion economic stimulus plan. The next 4 years of the Biden era will continue to provide that bullish backdrop for precious metals and commodity prices to skyrocket. In fact, last week platinum prices, they broke out to 4-year highs, whilst copper prices, they hit 8-year highs. Biden's green energy revolution will involve pouring trillions of dollars into renewable energy and green technologies such as electronic vehicles and solar panels, sectors that are heavily dependent on silver, on platinum, palladium and copper as key components. So Biden's pending energy policy has also benefited the oil market too, as more restrictive regulatory environment is expected to lead to higher prices. Indeed, last week crude oil prices, they broke out to 11-month highs, and Goldman Sachs have put it best here, predicting a new commodity super cycle as we go through 2021, and we're only just getting started. Now, going to next week, what you should have on the radar is that we have the Federal Reserve monetary policy meeting on Wednesday. Traders will be watching that closely for clues on how much stimulus is coming and when. Other market moving events next week will be Thursday's US Q4 GDP figures. That will also be a market moving event. Both those events, they're likely to have significant impacts on the markets, presenting again great trading opportunities. So with that, let's move over to the charts and we'll talk you through exactly what we're looking at here as we head into a new week. First of all, moving over to gold. As we told you last week, we were looking at any sell-offs at the start of the week as opportunities to reload. Feel free to go back and watch last week's commodity report. In fact, many of you have reached out that you were able to benefit from that. Certainly our clients at the Gold and Silver Club maxed that opportunity, banking 1,250 points on gold on Wednesday. So every one lot that you would trade, that's going to be $12,500 profit. Every 10 lots that you would trade, that's $125,000 of profit. So you'll see here gold essentially at the beginning of the week, we had a bounce back off the 1800 zone. This is the weekly chart, closing the week with a strong reversal and bullish engulfing. And you can see here, if you go out to the daily chart, where we had that V-shaped reversal and slingshot move of support at 1,803 US dollars per ounce. But again, many technical traders were caught on the wrong side of this. They were liquidated, so panic selling out when we had this large move to the downside on Monday, or they were margin called and also going into the wrong side of this position. So then they're seeing a close back below key support. They start selling into the market just as we're getting ready for Janet Yellen on Tuesday and also Wednesday's inauguration of Joe Biden. And with that of course helped to propel this slingshot move higher, which we benefited on with 10 stacked trades. And then we've seen the pause on Thursday on the European Central Bank announcement and the sell-off that we talked you through, in fact, on Thursday's silver asset of the day, which was to watch out ahead of contract settlement, which is going to be next week on Wednesday, the 27th of January, that often you can see a liquidation event in the lead up to that as capital flows out the market with the change in contract. So we've seen that again on Friday, but that provided again another great opportunity to get in, to add some additional positions, and now we're seeing strong support into the close. Again on the weekly chart here, you've got a strong reversal and we're back closed above 1,850 US dollars per ounce. Going into next week, this is what I would be looking at. So obviously we've got a very clear range right now, and some days last week gold was moving within a 400-point range. So you can see these are really the zones that I would look at for, again, more range-bound price action until potentially we get into the FOMC statement on Wednesday. Any pullbacks really that I see at the start of the week here, if we do get a rotation back down to liquidity, I would look at those as buy opportunities. We may not get that degree of a pullback. If we don't, and we immediately start to catch a bid going into next week, essentially what I want to see is a break above the neckline there. So as I mentioned before, we do still have positions that we've entered last week, particularly on Friday. We bought back into the dip here. So I am looking at a potential breakout later in the week next week, or we may see a pullback, and then I'm looking at sell-offs here back down to areas of liquidity liquidity to essentially establish additional trades there if we do see that. And then ultimately, as we go into February, I would look for this neckline to get breached. But again, you need to be nimble coming in and out the markets regularly, banking those profits. Now moving over to silver, as many of you know, our positions on silver are established between $22 up to $24 per ounce. We have 4 positions that currently are stacked on silver right now. So this is the zone where we've established our positions. We actually got a dip back down to that level at the start of last week. So some of you may have been very quick just to sniper in and get additional positions on that tap of $24 per ounce. If so, well done, because silver last week, it moved 5% off that level. It's closed back at $25.47 per ounce. Again, very similar to gold going into next week. We may get some range-bound price action in the lead up to the FOMC statement on Wednesday and the contract settlement that we have on Wednesday as well. But then later in the week, or into the first week of February, this is where we may get the neckline tested. And once we can break above 26 US dollars per ounce, we then have a block to fill, taking us back to the previous levels of resistance and the swing highs here as well. So that is what I would look out for. Essentially, if you were to get any pressure to the downside going into next week, I'd really look at opportunities, particularly around that 24 zone. We may not get that low, but if we do, I would see that as a great opportunity to essentially stack further trades if you were to get a sell-off down towards that level. But again, this just shows the need to be banking those profits regularly. The breakout that we saw in the first week of January, silver essentially, the sell-offs that we saw since then, we've seen almost a $4 sell-off. So if you hadn't banked any profits from, let's say, positions that you established over the months of October, November and December, you're pretty much back to entry price on some of those trades with the sell-off that we got at the beginning of last week, or potentially taken out of trades with no profit at all. So it is important to keep locking in those profits, but then reloading on positions and just take advantage of the current volatility. With platinum prices last week, if you go over to the higher time frames, you will see where we have essentially broken out to 4-year highs. So it's been a really strong move there. 3.4% move last week as well. So platinum is leading the precious metals at the moment. It's been a really solid move there over the last few days. Again, we've had a pullback in the lead up to contract settlement. As we go into next week, we may get some pause in price action on the metals in the lead up to Wednesday's FOMC statement. But then what you want to look out for is a break above this neckline. Once we clear above that level, much like we did going back towards the end of December, where we then propelled all the way up to the 1959 handle, this is where gold could start to accelerate. But ideally, you do not want to be FOMOing in. You don't want to buy in as the price is breaking out. You want to take advantage of these dips lower into areas of key liquidity. Big challenge we're seeing for many traders out there right now is they keep FOMOing in at the top and then they panic sell out at the bottom. And then they're getting chopped up all of the time because they're using outdated technical strategies, which just don't work in today's market conditions. As many of you know, trading commodities, it is a zero-sum game. So in order for someone to be making money, there has to be someone on the other side of the trade that's losing money. Predominantly, it is the banks, the hedge funds, the money managers, the market makers that are making the majority of profits in this market. And it's the majority of retail traders that are losing money because they're not taught the right way to trade. And if you're finding that you keep selling at the bottom and buying at the top, it's very likely that you've been taught outdated technical strategies that just don't work in today's market conditions. The good news is that majority of the world right now has got restrictions, lockdown. This is providing you with a fantastic opportunity, especially if you're working from home, in order to maximize it and not waste a good lockdown here. So instead of just striving at the moment, you really want to be thriving in these markets, learning the right approach to trading. The research-driven approach will help you massively. This is where you want to be trading the same way that the banks, the hedge funds, institutions are, utilizing our research, data, market intelligence, alongside sentiment, capital flows, daily, weekly, monthly cycles, the quarterly cycles, macroeconomics, marry that up with seasonality, intermarket correlations, the ratios in the market, geopolitical risk, and also aware of key liquidity zones, as it's just as important to know when to bank your profits as when to enter, if not in fact more important, to make sure that you're constantly banking those profits and building your portfolio. So with that, if you would like to learn the research-driven approach to the market, join our community of successful traders and join our professional mentorship program, there is an opportunity for you to do so. As a member, you get access to our exclusive live trading room webinars. You also get access to real-time trade ideas, institutional research and market intelligence, access to our private members academy website, and support and one-to-one mentoring. For more information, just go to www.jointhelivetradingroom.com. The link is also below this report in the description. So just click on the link, make an application, and we will of course get in touch with you ASAP. And do make sure you subscribe to our YouTube channel. That way you're always kept updated with all of the latest commodity reports.